Oil prices plunge on international markets. Many say it's not just about supply and demand. So what's behind the sharp drop in prices? Are politics involved? And who are the big winners and losers? This is Inside Story. Hello, welcome to the program. I'm Adrian Finnegan. The price of Brent crude oil slipped again on Thursday. A rise in global oil production combined with a drop in demand from slowing Asian and European economies means a grim forecast for global oil exporters. Prices are anticipated to fall as low as $55 a barrel in the short term. OPEC's revenue is likely to drop the most in more than a decade, and with continued Western sanctions, the Russian economy, heavily dependent upon energy exports, could even collapse. And as the US shale oil production continues to surge, the cost of production far exceeds the price per barrel, leaving little hope for a profitable future. So while consumers enjoy an extra jingle in their pockets this festive season, cash-hungry oil exporters are left with sleepless nights. Well, the oil crisis plays out differently across the globe, with some countries feeling its effects more than others. Let's take a closer look at the countries hardest hit by the drop in the price of oil. With 70% of government income dependent on its oil revenues, Nigeria is now forced to find income from alternative sources, such as electricity and farming. Oil revenues account for 80% of Saudi Arabia's government income. An almost 50% drop in the price of oil will reduce demand for its oil to the lowest level in more than a decade. That's going to hurt. And in Russia, 50% of state income comes from oil revenues. When combined with sanctions from the West, the Russian economy is expected to face some pretty difficult times ahead. Well, while for some countries it might be a nightmare, there are also countries that are benefiting from a drop in oil prices. Turkey, Japan and Brazil are just some of them. Let's take a closer look at the positive effects that it has on those countries. While its exports to neighbouring Russia may well suffer, Turkey could experience a drastic narrowing of its current account deficit on its oil bill. A fall in oil prices could hinder Japan's effort in tackling deflation. But for a country that imports almost $300 billion worth of oil per year, it's also bound to strengthen its current account balance. And state-controlled Petrobras in Brazil has been forced to import oil at world prices and sell domestically at government-capped prices. A drop in global oil prices means that it will no longer make a loss. India is another country that stands to gain a lot from the fall in the price of oil. Our correspondent in New Delhi, Karishma Vyas, reports.
A drop in oil prices is very good news for India. It imports 70% of its energy needs, and so the government is saving a lot of money now. Ordinary Indians also saving money at the petrol pump. Here's what they have to say.
Our budget is really coming down, and we feel good. The wages rates are also coming down, groceries, everything is coming down.
I hope it lowers down even further, but you know, it all depends on the international market, you can't say.
Lower oil prices also means lower inflation, and this is very important in India because the country has been suffering because of inflation. It peaked at around 10% last year, really hurting the middle class. So lower oil prices, lower inflation is going to provide some much needed relief to ordinary Indians.
Let's bring in our guests on today's programme who want to have their say on the price of oil. We have in London, Mamdouh Salameh, international oil economist and consultant on oil and energy for the World Bank. From Oslo, we're joined by Tina Soltvedt, senior macro oil analyst at the Department of Economic Research. And from Connecticut, David Nelson, chief strategist at Bell Point Asset Management. Welcome to all of you. Let's start with you, Mamdouh Salameh. What are we to make of the speed and depth of this correction in the price of oil?
Well, the price has been falling very quickly. We know the reasons. There was a bit of economic slowdown in the Asia-Pacific region as well as in Europe, plus the introduction of almost 2.5 million barrels of oil daily from the US shale oil production. However, I don't think these two factors have too much to contribute to this fast fall. I believe that the biggest reason is the failure of OPEC, the wrong decision they have taken not to reduce their production by more than 2 million barrels a day to absorb the glut in the market. That was a very wrong decision in my opinion, and it was taken not on the basis of real economic basis, but on the basis of politics, particularly from Saudi Arabia, who had the idea that they want to inflict some damage on Iran's oil economy and Iran as a whole, because I believe there is a proxy war between Saudi Arabia and Iran needs a price of $125 a barrel to balance its budgets. Even Saudi Arabia and the Gulf producers need $100 a barrel, but they have amassed a lot of funds which can take the pain for a short while.
Okay.
But believe me, they are playing with fire, because eventually it will create a huge deficit in their economies. And already the declining oil prices are planting the seeds for a huge oil crisis in coming year or 2016.
Okay, Tina Saltvet, do you agree with that? What's OPEC? What is Saudi Arabia up to here? Is Saudi playing with fire?
Well, it might be that they actually are, because in one kind of sense, I don't think either that the shale production in the US is actually surprising the market. That's been going on for some years now. So it's difficult to see where they're actually going, because leaving the thought of or the theory of what a cartel is supposed to do. I mean, on the web page, they're saying that they're going to produce, or the OPEC cartel is going to produce as much oil to balance the market. But at the moment, with no lowering of the quotas, I think that, or at least it seems that they're actually trying to push or squeeze some of the other producers out of the market. Of course, they're saying that they're going to protect the market share, and who they want to get out of the market is the shale production in the US. But that is a very short-term production. So if prices fall, of course, some of the producers will be squeezed out of the market, I think, during the first half of 2015. But of course, when prices started to increase again, these producers will soon be back in the market. So it is a bit unclear who they're actually going to hit with this. Of course, Russia is going to suffer big time from this sharp fall in oil prices, on top of the sanctions and the weakening of the currency as well. So there are a few countries who will suffer from this.
Okay, I want to come on to the consequences in a few minutes. But first of all, David Nelson in Connecticut, talking about OPEC and US shale in particular. To what extent has OPEC misjudged the threat from US shale?
I think you're bringing up a very important point, and I would agree with the doctor and Thina up to a point here. I think OPEC surveyed the landscape and realized that $100 oil is no longer defensible given the level of production coming out of the United States and some other parts of the world. And I think they understand that when OPEC is asked to cut oil by the other member states, what they really mean is they want Saudi Arabia to cut their production, because they have a long history of being the swing producer. And I think they decided that they no longer want to subsidize Iran, Iraq, Russia, and Venezuela. And the rising production in the United States, of course, is a threat that's been booming for years. The U.S. was on a path to energy independence. I think they understand that they can't eliminate it, but they can certainly slow it down. We're already seeing stress here in the United States with some oil companies, credit default swaps. The debt of some companies are trading at 50 cents on the dollar. That's severe stress. And Russia and Venezuela, their credit default swaps and their debt is a real issue, especially for Russia, whose currency has plummeted and inflation is now over 9%.
David, to what extent has US shale changed the global energy landscape? And to what extent is the resilience of US shale producers greater, perhaps, than the resilience of OPEC?
I can I can tell you as a portfolio manager here in the United States and as a strategist, we weren't even talking about energy independence in the United States 5 years ago. So I think the U.S. shale production has actually turned the energy markets upside down. I'm not sure that OPEC can actually be an effective force anymore, and I think Saudi Arabia is actually coming to grips with that. They realize that they have the reserves to deal with this problem. They can live with oil prices lower, certainly lower than what Iran, Iraq, Russia, and Venezuela can. And they've chosen to take this route. They do not want to lose market share, and they will do anything to keep it.
Mamdouh Salamet, what could happen to countries like Iraq, Libya, Algeria, if the price of oil stays as low as it is right now for the next 18 to 24 months?
Well, a low oil price will affect certain countries more than others. But in the final analysis, all of them will be losers from low oil prices. No matter what the reasons behind the reduction in the oil price, I don't think any of the reasons could justify a price of going to $60. First, let's look at Iraq. Iraq has possibly, in my opinion, one of the biggest oil reserves in the world, and it's very cheap to produce. But Iraq needs the money. Iraq, like Saudi Arabia and the Gulf producers, need a price of $100 or more to balance their budgets. There are some losers. For instance, Russia will need a price at least of $90 to balance their budgets. But remember that Russia is the 5th or the 6th biggest economy in the world, so they can tolerate more pain vis-a-vis the price than Saudi Arabia and the Gulf countries, and certainly more than Iran, Venezuela. For that reason, I would again say that all of them in the final analysis will be losers. But the biggest loser, in my opinion, will be the oil industry as a whole. The seven biggest oil producers in the world, 7 biggest oil companies, have already started selling some of their assets and reducing their investments. In doing that, they are probably will reduce their share of global production within 2 years, and that will put a very strong and solid floor under the oil price, and possibly will push the oil price up.
Okay.
One last thing I would say, the U.S. shale oil industry, while it is a fact of life and we should accept it, but I point out that there are 2 Achilles heels in that industry. One is that a well of shale oil production loses 70 to 90% of its production in the first year. This necessitates drilling thousands of wells to maintain production. Second thing is the oil price. It is true that their break-even price ranges from $70 to $85. Of course, the 70, the very efficient drillers can live with 70 or even 65. But there are many of them who cannot live with a price less than 80 to 85. So these are the facts of life, and we will have to live with these facts.
Okay. Tina, could this, the low price of oil, if it becomes entrenched, effectively bankrupt some of the smaller producing nations? And to what extent could the energy sector itself, as we were hearing just there, perhaps be heading for a recession? I mean, what would the implications for that be?
I think, of course, some of the smaller countries, which depends very heavily on oil export, will of course suffer. And maybe it's time actually that we're trying to look for some other, stable factors to bring in some income. So at some point, that oil production in some of the countries has been declining, but increases in the oil prices have actually saved the total income. But that can't last forever. So at some point you have to restructure your income to be able to stabilize your income for a longer term. So in that kind of sense, at some point they might actually have to do that anyway. I think for the whole oil industry as such, we're looking at a new sphere now, because we're having a new big player into the market, and I think what we're going through now is a period with a bit of turbulence until we find a new level of stabilization. And with the new player, because before OPEC was the big player, they controlled the market. That's not longer the situation. And with the US and Russia as big producers as well, I think you will see a new split of the oil production between the three big players here. And I think, you know, to find the right price, I think we have to go through this cycle now, and some will be squeezed out of the market. There will be some of the small commercial firms that might also hit some of the smaller countries as well. But I think we're looking for a new and stable and balanced price here, and that will take 1.5, maybe 2 years before we actually find that new price, the new equilibrium in the market.
David, is it too early to say that OPEC has become an irrelevance? I mean, these oil prices have effectively wrested control from what is essentially a cartel, haven't they?
Sure. I think, at least from my vantage point here in the United States, on Thanksgiving Day, a national holiday here in the United States, I think on that day, OPEC effectively committed suicide. They have left the market, and I think we're missing the larger point here, and Thina really hit on it. And the question is, what is the real price of oil? And we really don't know, because we've been living under the cartel structure of OPEC for 40 or 50 years, and oil certainly hasn't floated as a free commodity, and for the first time that it is. I'm not sure whether that price is going to be 30, 50, or 70, but I have a very strong suspicion that it's not going to be $100 a barrel, and that's going to inflict enormous damage on some of the countries mentioned, in particular Russia.
You talk about it, the price of oil floating freely. I wonder if any of what we're seeing that's going on right now in the oil market with this price slide, if any of that is to do with speculative bets by large financial institutions and hedge funds.
I'm sure that's somewhat true. Actually, this last push down with Brent now trading below, I'm looking at my screen right now trading below 63 in the futures market, and WTI here in the United States is broken below 60. Just this past week, and a lot of the U.S. Financial press were pointing out that hedge funds had made very large speculative bets, getting long crude, going into the last month of the year, thinking that there would be some type of reversion to the mean. Obviously, a lot of pain is being inflicted, and we're probably seeing some of those bets unwound right now.
Namda Salama, of course, something else that's playing into this is global demand for oil. It'll be weaker next year than was estimated a while ago, with output from non-OPEC members expanding. Why is that? Are we weaning ourselves off oil?
Not really, and I don't think there will be weaker demand next year, although OPEC is projecting that there will be demand of 28 million barrels a day for their oil instead of 30. But that projection is based on the fact that they are already overproducing by 2 million barrels a day. That's why I suggested that OPEC should have cut its production by a minimum of 2 million barrels a day to absorb the glut in the market. Vis-a-vis the global economic growth, I am hopeful that next year there will show some fast economic growth, particularly China and the European Union and the world as a whole. The fact that China is still growing at 7.2% per annum is a huge impetus to the global economy, and I believe that the price of oil will start to recoup most of its losses by the start of next year or 2016 at the latest. The global economy cannot reconcile itself with very low oil prices, because that will kill investment. It will kill the global oil industry, particularly the major oil producers. It could, to some extent, delay or reduce production from U.S. shale oil production because of low prices, and it will destroy a big chunk of the global economy, which is the economies of the Arab Gulf states, the producers. They have a GDP of 1.6 trillion, which is a big chunk of the global economy. So that's for these reasons I am saying that the global economy cannot reconcile itself with very low prices, and I am very hopeful. In fact, I believe that the oil price after it has settled to its lowest oil level, will start to pick up the pieces.
David, I see you nodding in agreement there. I mean, China has been driving demand for oil in the last decade. It's insatiable need, this thirst for fuel, hasn't it?
I would respectfully disagree with the doctor. I think the world will live very well with cheaper oil. What will happen is there'll be a transfer of wealth. I agree with the fact that China is a driving force, certainly in the world, and certainly has the highest GDP, but we really don't know what that is. We're hearing numbers like 7%, but frankly, the numbers have been suspect for years, and President Xi has actually been doing his best to kind of unwind some of the bubbles that exist in that economy. So they could actually we could see less demand from China than that 7% figure seems to represent. I think ultimately, cheaper oil, cheaper energy for the world is a wonderful thing. Obviously, it's bad news for some of the export-driven economies.
Tina, I mean, do you agree with that? I mean, speaking as an ordinary Joe here, it's great. I mean, prices already falling at the gas pumps. Am I going to see lower fuel bills in the future, cheaper airline tickets?
Well, in some kind of way you should do, because when the price of oil is falling, the price of oil products should be falling as well. So if the oil companies manage to transfer that into the prices of the products, that's of course a good thing for the consumers. In that kind of sense, I also think that some of the big importing countries should and maybe will use the opportunity to cut some of the subsidies, because I think high subsidies has been a very big burden on some of the budgets for the big importers. So when oil prices fall, and we saw that during the financial crisis as well, we saw some of them actually starting to get rid of these subsidies, because they have been a big burden for many of the countries. In that saying, when we talked about China, I also think that China, have an underlying change in their economy, going from heavy industry to lighter industry and to the consumer-driven, more consumer-driven economy. And in that kind of sense, I also think you see a cyclical change in the oil demand, but I also think that we're seeing a structural change in the oil demand from China, and that will last much longer. So I'm not sure we're going back to, even if China has higher growth than we're seeing now, I don't think we're going back to the place when we actually saw that Chinese demand was growing very fast.
And David, okay, many domestic consumers are seeing this as a boost. You're saying that lower oil prices are great news for everyone, but to what extent is there a danger lurking here? Could falling oil prices lead, for instance, to deflation? I mean, we already heard back at the beginning of the program that lower oil prices are not necessarily good news for a country like Japan.
I think the speed with which this is happening is probably the biggest danger that we face, certainly for some investors, and that the decline here in the United States, it's not just the oil companies that are in trouble, because the tentacles spread throughout the economy. It's the banking sector that I'm concerned about. Currently, 16% of junk debt in the United States is to energy companies, and when I see small oil companies like a Goodrich Petroleum, whose bonds are trading 50 cents on the dollar, I know there's distress. I know there's distress there. I think in the longer term, obviously, I think this is good news for the economy. It's getting the balance right between the supply and the demand. If this is a supply issue, and to a large degree it is, if it's a supply issue, then the prospects for the economy are certainly far better. But if this is a demand issue, then deflation is taking hold, and it's very serious, and it will have very large consequences.
And there, I'm afraid we're going to have to leave the discussion. Thank you very much indeed, all of you. Mamdouh Salama in London, Tina Saltvet in Oslo, and in Connecticut, David Nelson. And a reminder, you can find this show and many more at our website at Al Jazeera.